Here are the 4 factors that affect your interest rate if you're going to be either purchasing a home, doing a cash out refinance, or doing any type of second lien position loan like a HELOC, HELOAN, or closed-ended second. Number 1, loan to value, LTV, or if you're doing a second lien position, it's called CLTV, combined loan to value. Now, what that means is the more equity that remains in your home after the new loan, the better your interest rate is going to be. To give you an example, let's just say your home is $1 million. Your first mortgage balance is $500,000, and you want a line of credit or a second loan of $200,000 hypothetically. The combined loan between the first and the second is $700,000. On $1 million home, that would be a 70% loan to value, or in this case, 70% combined loan to value. You might get a better interest rate if you only took out $100,000 hypothetically, because the combined loan to value in that case would only be 60%. 500 on your first and only 100 on your second. The second factor is the credit score, right? So when it comes to credit, there's 3 bureaus, Experian, Equifax, and TransUnion. We're gonna go off of typically the bureau that shows your middle score. Whatever your middle score is, that's the score we use. Third factor would be debt to income ratio, right? To get the best rate, you want to be under 43%. You want your debt to income ratio to be as healthy as possible to ensure the better rate. Because if you're closer to 50%, you are going to get hit with a slightly higher interest rate because it's a riskier loan. Your debt to income ratio is higher. And the fourth factor is the loan size itself. You know, and sometimes there's really nothing we can do about this. You need a certain amount of money, and that's kind of what it is. But with that being said, the loan size would have probably the least weight on the interest rate, although it is a fact. You know, so again, when you hear someone talking about an interest rate, oh, I got a 699, I got a 599, their credit score is 750, so is mine. Why do I have a higher interest rate? Well, that's why. There's a constant balance of factors that will ultimately tell you what your interest rate is. Which is why when we send out what's called loan estimates, they are estimations, because once we get the appraisal back, if the appraised value comes in lower, that completely changes the structure of the loan. Our estimate on the home value was $1 million, came in at $889,000. That's going to change the loan to value, or the combined loan to value, which is going to ultimately change the risk of the loan and therefore the interest rate of the loan.